Hey everyone, welcome back to Rock Daily Talks, where we break down everything you need to take control of your finances. Today we're diving into a topic that's crucial for everyone looking to build wealth: investing mistakes. We all make them, especially when we're just starting out, but the key is to learn from them and avoid the common pitfalls that can derail your financial journey. So let's go over the 10 common investing mistakes and how you can stay clear of them. Now, I'm not here to scare you or make you feel bad about your past decisions. We've all made mistakes. I've made plenty myself. But the good news is, each mistake is a learning opportunity. And by understanding these common missteps, you can avoid them and make smarter investment choices going forward. The first mistake is diving into investing without a plan. Investing without a clear strategy is like setting sail without a map. You might get somewhere, but it's unlikely to be where you want to go. Before you start investing, you need to define your financial goals. Are you saving for retirement? A down payment for a house? Building a college fund for your kids? Knowing your goals will help you guide your investment decisions. Take the time to sit down and map out your financial goals. This doesn't have to be complicated. Just a clear understanding of what you're investing for, how long you have to reach those goals, and how much risk you're willing to take. Once you have a plan, stick to it. This will help you keep focus and help you avoid making impulsive decisions. When I first started investing, I didn't have a clear plan. I invested when COVID hit, just like everyone else who started a YouTube channel or something. I was just buying stocks based on tips from friends, other YouTubers, and headlines in the news. It wasn't until I sat down and defined my financial goals that I started to see real progress. Having a plan made all the difference in staying on track and building my portfolio with purpose. And just think, if you are planning for a long-term goal, let's say 20 years out, you can afford to take more risky, volatile investments, right? Markets going up and down. You can hold out for 10, 20 years. But if you need this money in 6 months or a year, you can't afford to invest in stocks that are very volatile, because by the time you're ready for a purchase, you're not able to time it and get out. And now when you need the money, you're possibly in a dip and then you're at a loss. But if you don't need that money for 10, 20 years out, you can plan and start to pull out your funds while it's at a number that you're comfortable with before you reach that target age or destination or goal. Another common mistake is trying to time the market. This is one of the biggest traps that even experienced investors can fall into. The idea of buying low and selling high sounds great in theory, but in reality, it's very, very difficult to do consistently. The market is unpredictable, and trying to time your buys and sell perfectly often leads to missed opportunities and unnecessary stress. Instead of trying to time the market, focus on time in the market. Historically, for the average person, staying invested over the long term has proven to be a more successful strategy. The market will have its ups and downs, but if you stay invested, you're more likely to see the positive returns over time. Let's break this down. Say you're waiting for the perfect time to buy a stock, thinking it will drop further. What if it doesn't? You could end up missing out on the gains because you were waiting for a dip that never came. On the flip side, if you're constantly trying to sell at the peak, you might end up selling too early, missing out on the additional growth. The key is to focus on the long term. Keep investing regularly and avoid the temptation of timing the market. Very often, if you're trying to time the market, you will make emotional decisions. You just can't help it, and you will do things that you're not supposed to do out of FOMO. Oh, I gotta assume people are new here. FOMO, fear of missing out. Remember it. Mistake number 3, lack of diversification is another mistake. Putting all your money into one stock or even one sector of the market is risky. If that investment doesn't perform well, it can take your entire portfolio down with it. Diversification is all about spreading your risk by investing in a variety of assets, different stocks and sectors, and even asset classes like bonds or real estate. A well-diversified portfolio includes a mix of large cap, mid cap, and small cap stocks, as well as bonds, real estate, and maybe some international exposure. This way, if one investment underperforms, others in your portfolio can balance it out. I learned this lesson the hard way in my investing journey. I was heavily invested in the tech stocks because they were performing so well at the time. But when the tech stocks weren't doing so well, my portfolio took a massive hit. It was a tough lesson, but it taught me the importance of diversification. Now I make sure my portfolio is well balanced across the different sectors and asset classes. Now, to be honest with you, a lot of those tech stocks would have rebounded anyways. You saw what happened with Facebook. It dropped by like 40%, and now it's way above that. It's doubled. But I felt better. And if I needed that money at the time, if there was an emergency, I would have been stuck. But for the most part, staying diversified helps me avoid some of those pitfalls. And if I'm in an emergency, I'm not going to stress too much because I'm diversified. Fees and expenses might seem small, but they can have a big impact on your investment returns over time. Whether it's management fees, a mutual fund, the trading fees on individual stocks, or the expense ratios on ETFs, these costs can add up and eat into your profits. Before you start investing in anything, take a look at these fees and expenses involved. Low-cost index funds and ETFs are a good choice because they typically have lower fees than actively managed funds. Over the long term, reducing fees can significantly boost your returns. Let's say you invest $10,000 in a mutual fund with a 1.5% annual fee. Over 30 years, that fee could cost you tens of thousands of dollars in lost returns. Now compare that to an index fund with a 0.1% fee. The difference in your portfolio value can be staggering. It's a reminder that even small fees can have a big impact over time. Mistake number 5, letting these emotions drive your decisions. We talked about it earlier. Letting emotions drive your investment decisions is another common mistake. It's natural to feel anxious when the market is down or euphoric when the market is up. But making decisions based on these emotions can lead to poor outcomes. For example, panic selling during a market dip can lead to losses, while buying into the hype during a bull market can lead to overpaying for overvalued assets. The key is to stay disciplined and stick to your investment plan, regardless of what the market is doing. Remember, investing is a long-term game, and short-term market movements shouldn't derail your strategy. I've been there. During market downturns, it's tempting to sell everything, cut your losses. I've done it with Tesla so many times. But some of my best investments have come for staying the course during tough times. Once I finally learned my lesson and Palantir, but you're not here for individual stock advice on this video. By keeping a level head and sticking to my plan, I've been able to ride out the storms and come out stronger on the other side. You're going to find with these videos, I've had a love-hate relationship with Tesla because it is the company / stock that really helped me learn to manage my investments, manage my emotions with investments, because that one has been a volatile one. And so I'm just ready for anything. I do want to add, because of my investment plan, that is why instead of panic selling, I just average a little bit more into the stocks that match my investment strategy. But that's something to touch on later. Subscribe so you don't miss out on those kinds of tips. Overreacting to market news is a close cousin to letting emotions drive decisions. The financial media is full of headlines designed to grab your attention, often focusing on short-term market fluctuations. While it's important to stay informed, making investment decisions based on daily news can lead to knee-jerk reactions that hurt your portfolio in the long run. Instead of reacting to every piece of market news, focus on your long-term goals. Keep an eye on the bigger picture, and remember that most daily market movements are just noise. If you have a well-thought-out investment strategy, you don't need to change course every time there's a headline about market volatility. I've learned to take the market news with a grain of salt. Early in my investing journey, I'd get caught in the headlines, buying or selling based on what I've read, but over time, I've realized that sticking to my long-term plan and tuning out the noise was a far more effective strategy, and for the most part, I've had significant more gains by just writing things out, following my investment strategy. Mistakes number 7, not reinvesting dividends, folks. Dividends can be a powerful tool to building wealth, but only if you reinvest them. Not reinvesting your dividends is a missed opportunity to compound your returns over time. When you reinvest dividends, you're buying more shares of the stock or fund, which can generate more dividends in the future. It's a cycle of growth that can significantly boost your portfolio's value. Most brokerage accounts allow you to automatically reinvest dividends, so take advantage of this feature. Over time, reinvesting in dividends can lead to substantial growth, especially in dividend-paying stocks or ETFs. Let's say you own shares in a dividend stock that yields 3% annually. If you would reinvest those dividends instead of cashing them out, you're buying more shares, which will pay more dividends next year, and so on. Over time, this compounding effect can turn a modest dividend yield into a significant portion of your portfolio's growth. Mistake number 8, chasing performance. Chasing performance is a common trap, especially for new investors. It's easy to get caught up in the excitement of a stock or fund that's performing well and jump in, thinking it will continue to rise. But past performance is not always indicative of future results. Just because an investment has done well recently doesn't mean it will continue to do so. Instead of chasing the latest hot stock or fund, focus on building a diversified portfolio that aligns with your long-term goals. This approach is more likely to lead to consistent, sustainable growth over time. I've made this mistake before, buying into a stock just because it was the top performer of the year, only to see it plummet soon after. It's a reminder that investing is about discipline and sticking to your strategy, not chasing the latest trend. Mistake number 9, neglecting tax efficiency. Tax efficiency is often overlooked in the world of investing, especially for newbies, but it can have a big impact on your returns. Different